63. That's how many ounces of silver it took to buy 1 ounce of gold in February 2021. Today, it takes 92 ounces. The gold to silver ratio just hit its highest level since the COVID panic of 2020. Gold climbed to $4,477 yesterday. Silver, $70.41. Both are at all-time highs. Both are over 130% in 2025. But here's what Wall Street isn't telling you. The ratio says silver is 40% undervalued compared to its 25-year average. 40%. And history shows us something fascinating. Every single time this ratio spikes above 90, silver doesn't just catch up to gold, it massively outperforms. We've seen this movie before, Act 3 of a 4-act play. In 2020, the ratio hit 125. Silver then gained 102% over the next 18 months. In 1991, the ratio hit 97. Silver doubled. In 2003, it peaked at 80. Silver went up 340% over 5 years. Everyone's watching gold break records. But the real opportunity? It's in the metal that's been left behind. And if the pattern holds, if mean reversion plays out like it always does, we're looking at $80, $100, maybe higher. Before 2026 ends, let's start at the beginning. 15 to 1. That's what the Coinage Act of 1792 established. 15 ounces of silver equal 1 ounce of gold. By law, the US government fixed the ratio because both metals were money, real money. You could walk into a bank with 15 silver dollars and walk out with 1 gold dollar. Guaranteed. That ratio held remarkably stable for over a century, not because of market forces, because of the government mandate. Silver and gold were the monetary system, the backbone of commerce, the foundation of trust. But here's what changed. In 1873, something called the Crime of 1873, silver was demonetized, removed from the monetary system. Gold became the standard. Silver became just another commodity. And the ratio started drifting, 20 to 1, 30 to 1, 40 to 1. By the 20th century, after both metals were completely removed from currency, the ratio became purely market-driven. And markets are messy. Emotions, supply shocks, industrial demand, monetary policy, all of it is pushing and pulling the ratio in different directions. But here's the fascinating part. Even without government mandates, even in a pure market system, the ratio has exhibited mean reversion for over a century. It swings wide. Sometimes gold gets expensive relative to silver. Sometimes silver catches up. But it always reverts toward a long-term average. From 1900 through today, that average sits between 50 and 75 to 1. And whenever the ratio moves far beyond those bounds, it creates opportunity. Not speculation, mathematical opportunity. Because extremes don't last. Markets revert to means. And right now, at 92 to 1, we're sitting at an extreme. An extreme that historically precedes massive silver outperformance. That's the setup. That's Act 1. Understanding the ratio's history and why it matters. Now let's talk about what happens when the ratio spikes. When gold runs and silver lags. When the gap stretches to levels that scream reversion is coming. March 2020. COVID panic. Global markets in free fall. Gold surges as investors flee to safety. Silver markets seize up. Physical shortages, trading disruptions, panic everywhere. The gold to silver ratio explodes to 125 to 1. The highest reading in modern recorded history. Silver was trading around $12, gold around $2,100. The math said silver was catastrophically undervalued. But in panic, nobody cares about math. They care about liquidity, safety, survival. So gold won, temporarily. But then what happened? Over the next 18 months, silver went from $12 to $29, a gain of 142%. Gold went from $2,100 to $1,800. It fell. Silver didn't just catch up, it crushed gold's performance. The ratio collapsed from 125 to 63 by February 2021, mean reversion in action. The rubber band snapped back. And anyone who recognized the pattern, who bought silver when the ratio was screaming undervaluation, made enormous returns. Go back to 1991, recession. Silver falls to under $4 per ounce. Multi-decade lows, soft industrial demand. Nobody wants it. The ratio hits 97 to 1. And then silver doubles over the next 2 years while gold stays flat. Ratio compresses back toward normal. Another peak. Ratio hits 80 to 1. And what follows? A 5-year bull market in silver. From $4 to $21, 340%. While gold went up? Sure, but silver's percentage gains absolutely demolished gold's. This is the pattern. This is Act 2. When the ratio spikes above 85 or 90, silver historically enters a period of massive outperformance. Not because silver is magic, because math, because reversion, because markets don't stay at extremes forever, and we're at 92 right now, December 24th, 2025. The ratio hasn't been this high outside COVID panic since before the global financial crisis. We're at the setup. The exact setup that has preceded every major silver surge in modern history. So let's talk about today, right now. What's actually happening in the market? Gold hit $4,477 yesterday, all-time high, up 70% in 2025. Everyone's talking about it. Central banks are buying record amounts. Geopolitical tensions, dollar debasement fears, the haven trade. Gold is the story. And silver? Silver hit $70.41, also an all-time high, also up 138% in 2025. But here's the thing. Despite both metals rallying hard, despite both breaking records, the ratio is still elevated, still at 92. Think about what that means. Silver has gained 138%, gold has gained 70%. Silver is actually outperforming. But it's not outperforming enough yet to bring the ratio back to historical norms. If the ratio were to revert just to 75-1, which is the high end of the historical average, silver would need to hit over $59 with gold at current prices. But we're already at 70. So, for the ratio to compress to 75 while both metals are still rising, silver would need to hit $85 if gold stays at $4,400, or $100 if gold goes to $50,000. And here's the kicker. The ratio typically doesn't just revert to average, it overshoots. Markets swing from one extreme to another. When the ratio was 125 in 2020, it didn't just drop to 75, it fell to 63, below the long-term average. Because when silver catches momentum, when the crowd realizes it's been left behind, the move is explosive. Every financial advisor, every analyst talking about precious metals right now is focused on gold. 4,000 plus per ounce. Feels expensive. Feels like you're buying at the top. Silver at $70, still accessible, still affordable for retail investors, and that psychology matters. During precious metals, bull markets, retail buyers favor silver. The entry point is lower. You can buy meaningful amounts. And when retail piles in, when momentum builds, silver doesn't just catch up. It goes vertical. We saw it in 2011. Silver went from $30 in December 2010 to $49 by April 2011. A 60% gain in 4 months. Parabolic. Driven by retail frenzy. Driven by the perception that gold was too expensive, but silver was still cheap. And what was the gold-silver ratio doing before that surge? It was elevated, around 68-1. Not as extreme as today, but elevated enough that when the move started, silver absolutely exploded relative to gold. We're seeing the early signs now. Silver ETF Inflower S at record levels. Physical premiums are rising. Mints are struggling with supply. Retail demand is surging. The story is starting to shift from gold is safe to silver is undervalued, and the fundamentals support it. The Silver Institute projects a 95 million ounce deficit in 2025, fifth consecutive year of deficit. Industrial demand is at record levels. Solar panels, electric vehicles, and data centers are all consuming silver at accelerating rates. 200 million ounces for solar alone in 2024. Supply can't respond. 70% of silver comes as a byproduct. My output grew by 1% this year. New projects won't come online for years. The physical market is tight, tighter than gold. Because gold doesn't get consumed, it sits in vaults. Silver gets consumed, used up, gone. So you have a market with structural supply deficits, record industrial demand, surging investment demand, and a gold to silver ratio sitting at 92, 40% above the historical average, screaming that silver is undervalued. That's Act 3, the current setup. The moment when all the pieces are in place for mean reversion to accelerate. Now let's zoom out. Let's see the full pattern clearly. The gold-silver ratio is a barometer. It tells you which metal is expensive and which is cheap relative to their historical relationship. When the ratio is low, below 50, gold is cheap relative to silver. When it's high, above 85, silver is cheap relative to gold. And here's what history teaches us. The ratio doesn't stay at extremes. It reverts. Sometimes quickly, sometimes over the years. But it always reverts. From 1900 through 1930, the average ratio was about 38-1. From 1930 through 1970, around 46-1. From 1970 through 2000, 55-1. From 2000 through today, 65-1. The modern average, the past 25 years, sits around 70-75. And we're at 92. That's not a small deviation. That's a 23% premium to the upper bound of normal. In a market where percentages mean everything, that's enormous. And here's the critical insight. Silver doesn't need gold to crash for the ratio to compress. Both can keep rising. Gold can hit 5,000. Silver just needs to rise faster. And when silver catches momentum in a precious metals bull market, it always rises faster. Why? Because silver is smaller. The entire above-ground silver market, all the silver that exists in investable form, is worth maybe 80 to 100 billion dollars. Gold? 10 trillion. Gold is 100 times larger. So when capital flows into precious metals, a small percentage of that flow into silver moves the price dramatically. Think about it. If $10 billion flows into gold, it's 1/10 of 1% of the market. Barely noticeable. If 10 billion flows into silver, it's 10 to 12% of the market. Massive. Price moving. Explosive. This is why silver is the leveraged play on precious metals. Why is it called poor man's gold? Not because it's inferior, because it's smaller, more volatile, and amplifies moves in both directions. And right now, the ratio is telling us silver is set up for one of those amplified moves. To the upside. Compressed by mean reversion. Accelerated by structural fundamentals. Driven by retail momentum. BNP Paribas said $100 silver is possible. Bank of America's technical team is bullish. UBS is forecasting continued strength. These aren't fringe voices. These are major institutions recognizing what the ratio is screaming. But here's what makes this different from speculation. This isn't about predicting that silver will go up because of some narrative. This is about recognizing a mathematical relationship. The ratio is at 92. The historical average is 75. Reversion is inevitable. The only questions are timing and magnitude. Conservative scenario? Ratio reverts to 75 by the end of 2026. If gold stays at 4,400, silver hits $59. We're already at 70. So gold would need to rise for that math to work. If gold goes to 5,000, silver hits 67. Still profitable, but not explosive. Moderate scenario? Ratio reverts to 65. Historical average for the past 15 years. At 4,400 gold, silver hits $68. At 5,000 gold, silver hits $77. That's the 100 to 120% gain range. Aggressive scenario? Ratio overshoots as it did in 2021, falls to 60. At 5,000 gold, silver hits $83. At 5,500 gold, silver hits $92. The double your money scenario, and the most aggressive? The ratio falls to 50, like it briefly did in 2011. At 5,500 gold, that's $110 silver. At 6,000 gold, $120 SAR silver. The life-changing return scenario for anyone positioned now. I'm not saying which scenario happens. I'm saying all of them are mathematically plausible based on historical precedent. The ratio has compressed from these levels before, multiple times. It will compress again. The only question is how far and how fast. So what does Act 4 look like? What happens when the reversion accelerates? Here's what we know from past cycles. Silver moves in stages during bull markets. Stage 1, gold leaf buying. Central banks, institutions. Gold rallies and silver follows but lags. The ratio expands. This is where we've been for most of 2025. Stage 2, silver starts catching up. Ratio begins compressing. Retail notices. Investment demand picks up. ETF inflows accelerate. This is where we are now. Silver ADAS Allen L-time high, but the ratio is still elevated. Stage 3, silver goes parabolic. Ratio compresses violently. Retail FOMO kicks in. Everyone who missed gold at $2,000 piles into silver at 60 or 70. The momentum feeds on itself. The media covers it. More buyers flood in. Silver doesn't just catch gold's percentage gains, it doubles them. Stage 4, the peak and crash. This is the part most people ignore. Silver doesn't stay parabolic forever. The ratio overcompresses. Silver gets expensive relative to gold. And then it corrects violently, faster than it rose. This happened in 1980. In 2011, it will happen again. But we're not in stage 4. We're in stage 2, approaching stage 3. The setup, not the peak. And understanding that distinction is everything. In 1980, silver went from $6 in 1979 to $50 by January 1980. 800% gain. But then it crashed to $10 by March. Silver Thursday. The Hunt brothers? Margin changes. Regulatory intervention. People who bought at 45 got destroyed. But people who bought at 6 or 8 or even 12, they had time. They saw the run. They could take profits. The key wasn't predicting the exact top. The key was recognizing the setup when the ratio was screaming opportunity. In 2011, silver went from $18 in August 2010 to $49 in April 2011. 172% gain, but then it crashed to $26 by September. People who bought at 45 suffered, but people who bought at 18 or 22, they had a window. Right now, we're at $70. After a 138% gain in 2025, some might say we're late, that the move has happened. But the ratio says otherwise. The ratio says we're still in the setup phase, because historical reversion hasn't happened yet. If the ratio compresses to 65, we're talking another 20 to 30% from here. If it compresses to 60, 40 to 50%. If it overshoots to 50, 70 to 80%. Those aren't small moves, and they're not speculation. They're mathematical outcomes of mean reversion. The risk? that the ratio doesn't revert, that some new paradigm has emerged where 92 is the new normal, that gold stays permanently expensive relative to silver, but 125 years of data says that's unlikely. Ratios revert, markets revert, math wins. The other risk? Timing. Maybe reversion takes 3 years instead of 1. Maybe we trade sideways while gold catches up. Maybe some external shock disrupts the whole precious metals market. Those are real risks. But there are risks in every trade. The question is whether the setup justifies the risk. And at 92 to 1, history says yes. So where does this leave us? What does this actually mean for investors? Gold at $4,477. Everyone is watching it. Everyone is talking about records. Feels expensive, feels late. But silver at $70? With a 92 gold-silver ratio? That's the opportunity hiding in plain sight. Think about the math, simply. If you buy gold here and it goes to 5,000, you make 12%. If you buy silver here and the ratio reverts to 75, you make similar returns, but with a smaller capital requirement. But if the ratio compresses harder to 65 or 60, silver could double while gold gains 20 to 30%. This isn't a binary choice. Many investors hold both. But the ratio tells you where the asymmetry lies right now. Gold is priced for perfection. Silver is priced for continued underperformance. And history says when that setup exists, silver is the better bet. Here's the other piece. Accessibility. A 1-ounce gold coin costs $4,400. A 1-ounce silver coin costs $70. For retail investors, for people building positions, for anyone who wants meaningful exposure to precious metals, silver is simply more practical. And that practicality matters in bull markets. When the crowd gets involved, when your neighbor starts asking about precious metals, they're not buying gold at $4,400. They're buying silver at 70, 80, or 90. And that demand, that retail wave, is what drives the parabolic stage. We're starting to see it. Silver ETF inflows are at record levels. Physical premiums are rising. Mints are selling out. The story is shifting from gold safety to silver's value. And once that narrative takes hold, once the ratio compression story gets mainstream attention, the move accelerates. BNP Paribas, Bank of America, UBS, they're all bullish on silver. Not because they're pumping it, because they see what the ratio is saying. They see the fundamentals. They understand mean reversion, and they're positioning their clients accordingly. But here's what I want you to understand. This isn't financial advice. This is pattern recognition, historical analysis, mathematical framework. The gold-silver ratio at 92 is elevated, 40% above historical norms. Every time it's been this high in the past, silver has outperformed gold over the following 1 to 3 years, sometimes by small margins, sometimes by massive ones. The setup exists. The ratio screams opportunity. The fundamentals support it. The history validates it. What you do with that information is your decision. Think of silver like this. Gold is the defensive play, the haven, the asset that preserves wealth during chaos. Silver is the offensive play, the catch-up trade, the asset that amplifies gains when precious metals are in bull markets. Right now, both are working, both hitting records. But the ratio says silver has further to run. And if history is any guide, the next 6 to 12 months could be when that catch-up accelerates, when 70 becomes 80, 80 becomes 90, 90 becomes 100. Or maybe the ratio just slowly compresses over the years and silver does okay, high but not explosively. That's possible too. Markets don't have to do anything. But probability, based on 125 years of data, suggests reversion. And reversion from 92 to 75 is a move worth positioning for. The conservative case says 15 to 20%. The moderate case says 40 to 60%. The aggressive case says double. All of those are positive expected values. All of those justify attention. And all of those come from the same simple truth. The ratio reverts. It always has. It likely will again. So ask yourself, can you see the pattern? Can you see why everyone watching gold might be missing the real opportunity? Can you see why the gold-silver ratio at 92 isn't a random number but a mathematical signal? Drop a comment. Tell me which scenario you think plays out. Conservative reversion, moderate compression, aggressive overshoot? Or do you think this time is different, that the ratio stays elevated permanently? And if you want to understand what happened the last time silver went parabolic, hit subscribe. Because next week, I'm breaking down the 2010 to 2011 silver bull market, the signals that appeared early, the momentum that drove it to $49, and the crash that followed, so you can recognize not just when to position, but when to take profits. The gold-silver ratio doesn't lie. It's math, it's history, it has probability. And right now, at 92 to 1, it's saying silver is the play. Not because silver is better than gold, because silver is undervalued relative to gold. And undervaluation, over time, gets corrected. Gold might go to 5,000. Silver might go to 80. Both can be true. But if you're looking for asymmetric returns, if you're looking for the metal that could double while gold gains 20%, the ratio is pointing one direction. Everyone's watching gold break records. The smart money is watching the ratio and positioning for what comes next.